Yo, it's your boy Felix, and welcome back to another interesting episode on 12 of FX. And today I'll be analyzing the AT&T Telecommunications. So without further ado, let's jump right into the chart. So whenever I'm given an asset, the first thing I always do is try to establish the direction of the asset. And one of the ways I do that is by going to the highest time frame. So anything from the daily to the monthly is all considered higher time frame. See the market. Either the market is making higher highs, higher lows, which is an uptrend, or the market is making lower lows, lower high, which signifies a downtrend, or the market is moving within a range. In this case, the market has been making higher highs, higher lows, which is this is the high, a low, a high, a low, a high, a low, a high, low. So the market has been making higher highs, higher lows, which mean we're an uptrend. And guys, whenever I hear the word trend, always picture a 5-wave pattern, because a trending market unfolds in a 5-wave pattern. So in this case, if you have an uptrend, it unfolds in a 5-wave pattern. 1, 2, 3, 4, 5. And within the fractals, wave 1, wave 3, and wave 5 are called impulsive wave because they move in direction of the trend, which is an uptrend. Wave 2 and wave 4 move against the trend, so they're called corrective wave. So whenever you have an uptrend, you also have what called fractals. So within the impulsive wave, you have a 5-wave pattern also. And for the third wave, you also have a 5-wave pattern because it's an impulsive wave that moves in the direction of the trend. And the last impulsive wave is the 5th wave, which is a 5-wave pattern. Why wave 2 and wave 4 are called corrective wave, and they have an ABC pattern, which is a 3-wave pattern. And this A, B, C. And wave 1, which is an impulsive wave, the first impulsive wave has a 5-wave fractals within it. So if I get my drawing tool, this is wave 1, wave 2, wave 3, wave 4, and wave 5. So definitely this is wave 1, wave 2, wave 3, wave 4, and this should be wave 5. So this is the first wave. Get this. So this is the first wave, the second wave, and now the third wave. I'm going to count the fractals within this third wave. If I should zoom in, and with the aid of my trend channel, I can get the fractals of the third wave easily. Second, third, the fourth, and the 5th. So at the end of the third wave, what comes next is the 4th wave, which the 4th wave is an ABC pattern. So now we are on the 4th wave. So it is a corrective wave pattern. Why? Because it goes against the trend. We have an uptrend, and you have something that goes against the trend. So it goes against. So the 4th wave is a corrective wave pattern because it goes against the trend. Wave 1, wave 3, and wave 5 are impulsive wave. Wave 2 and wave 4 are called corrective wave because they go against the trend. And there are 2 ways you can see the corrective wave. The first wave is an A, B, C. The first case is that the A wave is a 3-wave pattern. A, B, C. The B wave remains the same as the 3-wave pattern. A, B, C. And the C wave is always a 5-wave pattern. And the second way you can see the corrective wave is the A wave is a 5-wave pattern. the B wave remains the same as a 3-wave pattern, and the C wave remains the same as the 5-wave pattern. So this is a 5-wave pattern. So in this case, in a corrective wave pattern, what remains the same is the B wave and the C wave. The A wave only changes. So the A wave could that be a 3-wave pattern or a 5-wave pattern. I'm going to implement what I drew here onto the chart. So if you go to the chart and I zoom in to the corrective wave, I could see that this is the A wave, where is this a 5-wave pattern? This 1, 2, 3, 4, 5. And what comes next is a B wave, where this is the B wave, which is always a 3-wave pattern. This is A, B, C. And the C wave is always a 5-wave pattern. So this is the 5-wave pattern, and so at the end of the 4th wave, what to expect will be a massive 5th wave. But to understand what's happening in this market, one needs to understand the psychological aspect of this market, and I'll give a brief summary of it. So basically, around this area down here is what they call, traders usually call it psychological area or area of demand. Why do I say area of demand? Because at this area, a lot of institutional traders like the banks, large investors, and all these guys that trade billions of dollars in the market, they were aggressive with their position around this area. They bought aggressively around this area, and that led to this massive bullish move upward. But before they took a buy trade, they sold the market first before buying. So meaning they have an open sell position here. Even though they were profit around this area, they still had an open sell position around this area. And secondly, when they bought, they have their stop loss placed around this region. So that created a pool of money. And in addition to that, you have what they call the retail traders, which is like me and you and guys trading from home, where we don't have enough money to push the market, but we still benefit from trading the market. Some retail traders have their sell stop placed at this position because this is an area of support, and they hope that when the market break this area, that sell trade will be triggered. So what happens is that when they have the sell stop placed around this area, they have that stop loss placed above this area. So that creates what they call a pool of money or area of liquidity in the market. And this is where banks go after. Banks go after pool of money, go after pool of liquidity, because they use retail trader money to, they use the money got from retail traders to push the market into that direction, because they use the money from retail traders to push the market in that direction. So basically, what to expect that the market will gain a form of support around this area. So back to the market structure. Since I said the C wave is always a 5-wave pattern, this is the first wave, the second wave, third, fourth, and the 5th wave. So this 5th wave is a bearish impulsive wave, because this C wave is a bearish wave, and the wave that moves in the direction of the C wave are called impulsive wave. So it's meant to be a bearish impulsive wave, because C wave is a bearish wave. So meaning what to expect a 5-wave pattern within this C wave. So I can't really see the fractals properly, but I'll go down to the lower time frame to count the fractals. If I go down to the weekly, what can we see, guys? Right now I can see there's the first wave, the second wave. You can see the green candlestick, which was a retracement, second wave, the third wave, a pullback, and the 5th wave. To be planning on taking the buy trade, because at the end of the 4th wave, what comes next will be an impulsive 5th wave pattern, But before you place a buy trade, you have to be sure that the fourth wave has fully formed. And one of the ways you can confirm your entry is by looking for break of structure. So you can see at this area, this minor fifth wave, the market has been making lower lows, lower highs, lower low, lower high, lower low, lower high. So this was a high, and this is a minor high. This high is higher than this high. So it's making lower lows, lower highs, lower lows, lower high. So what to expect after this was what? A lower low and lower high. But instead, what happened that there was a break of structure. You could see a break of structure, which indicates change of character in the market. So it's a very good time to buy the market if you're planning on buying the market. But if you're still not sure, you can scale down to the lower time frame. Only trader and not investing, it's advisable to try place your entry from a higher time frame and not trying to go down to the lower time frame, because the lower you get into the time frame, there's a high chance of you making error. So you can place a buy trade because you can see a break of a major structure that was protected by the bank. So there was a money resting above here, and the market broke the structure, took the liquidity down, and the next step is going to go upward. So where should be your profit target level? A profit target level, I'll have to go up to the highest time frame, like the monthly time frame. My first profit target level will be at this area down there, which is at 44.38. Why did I say so? I say so because you have a lot of money resting above this area, because the banks sold heavily around this area, so there's a lot of liquidity resting above here. And secondly, you have retail traders that see this area as area of resistance, and they hope to take a buy trade when the market breaks this area of resistance. So you have buy stop placed at this area with a stop loss placed below here. So what that consists of an area of liquidity. So the banks always target area of liquidity. So they take out internal liquidity and target external liquidity. This is an external liquidity because this was the major swing in the market. This was the major high in the market. And the internal liquidity we have here is this trend line liquidity down here, because around this trend line, you have a lot of stop loss placed above here, stop loss placed above here, stop loss placed down here. You have stop loss placed here. So what the market is gonna do is that it's gonna go upward. It's gonna go upward, clear all these guys out of their position, and head towards this external liquidity, this external area at this level down here. So that should be a profit target level. So in summary of my analysis, I said this is the first wave, second wave, third wave, the fourth wave, and the fifth wave. And we should expect a form of support around this area of demand, because this is an area of liquidity in the market, and you have open sell position placed by institutional traders that they have to close. And secondly, you have retail traders that see this area as area of support, and once it get broken, they place a sell stop position down there with a stop loss placed above here. So the stop loss from the retail traders and the stop loss from the financial institution and the open sell position makes this area attractive. That's why it's called psychological area. And this for the fourth wave, there is an A, B, C correction. And your target level should be around this area. So you wait for the break of structure, which would see that this was meant to be a 5 wave, because the C wave is always a 5 wave pattern, where this is the first wave, second wave, third wave, fourth wave, and the fifth wave. And the break of structure of the internal structure of this fifth wave is a confirmation for you to take a buy trade, because our target is, we're trying to target this fifth wave, this fifth impulsive wave. So on the break of this structure, you take a buy trade, which is at 21.40, and your target level, your first profit target level should be at 45.41. And I said this area because at this area, you have a lot of stop loss placed by institutional traders, and you have retail traders that see this area as a resistance, and once it gets broken, they've placed a buy stop position. So what happens that they have that buy stop placed around this position with that stop loss placed below here, and they hope that once the market gets broken, it will trigger that trade. So what happens that the stop loss placed by retail traders and the stop loss also placed by institutional traders will constitute a pool of money, which is an external liquidity resting above this major swing or this major high. And banks always target liquidity. They always target external liquidity. So they will take out internal liquidity. So you have internal liquidity resting above this trend line down here. They take out internal liquidity and they head towards external liquidity, which is this resting above the major swing. And that is it today, guys, for this video. If you like what you're watching, don't forget to like, comment, and subscribe. See you guys on the next episode.